Okay, so one of my favorite aspects of trading is being able to spot the flow of a trend in price action. If you can do that right, you can be incredibly effective at trading the markets, and that's precisely what we're going to talk about in today's video. I've had a ton of success with my scalping system lately, and I'm going to show you the tricks I use to spot momentum in these markets. Before we take a look at that though, if you want to help support the channel, hit the like, hit the sub button below, and join us every weekday morning right here on YouTube as we day trade the market on stream for free. Now, with that said and out the way, let's take a look. Okay, so the first thing I wanted to show you about understanding momentum and really reading the flow of a stock's movement, you have to understand what wicks do and the significance of analyzing them. Now, when we take a look at the SPY here, which is just the mini S&P 500, you can see a few very subtle but really eye-opening things about price action with wicks. Number one is that you can see up wicks can identify downward pressure. So if a stock has an up wick like this, say here, you could see what happens afterwards. It goes down within the next 10 to 15 minutes. On the other side, if a stock has a lot of down wicks, it can be really indicative of buying pressure. So you can see some down wicks here, some down wicks here. Even on a short-term basis, you can see a down wick here and then a quick move back up. And so down wicks can be indicative of buying pressure and up wicks can be indicative of selling pressure. And the common logic is the larger the wick, the more pressure that is there. If you look at a really large wick, usually you'll see some pressure on the opposing side, and again, the larger the wick, the more pressure there is. And you can really use this for your price action to base your trades off of. You don't want to use it solely to base your trades off of, but if you have a stock that's maintaining a specific trend and then you have a really nice confirming wick that's really big that you can use to judge where the momentum is flowing, again, it can just be a really profitable thing to take advantage of. And so with that, let's take a look at a few trade examples of using this type of price action to determine where you're entering, exiting, and more. Okay, so I'm looking at the SPY here, and again, we can see some down wicks at the 435.50 area. Number one, this is a $0.50 level that stocks tend to respect and bounce off of. And number two, we can see a lot of wicks that are indicating some pressure. You can see this wick right here that is indicating some upward pressure. And if you really think about why this works, in order for a candle to form a wick, it has to be pushed really quickly in the opposing direction. And so for this wick to form, it has to be pushed really quickly in the upward direction, again, thus forming this wick. And so when you have that type of readable pressure, again, you can base your trades off of, and it's one of my favorite things in short-term trading. Here's another great example of it on the long side. Again, you can see the wicks starting to form. You can see there's one wick there, a wick on the other side, which just means indecision and neutral action. But then you see the wicks starting to build up on the downside. When this starts to happen, you can see what happens next is that the stock starts to push up in that upward direction because other traders are able to identify where this pressure is coming in from these wicks. And so when you have some movement like this where you have a lot of wicks on the downside and really small wicks on the upside, again, that's telling you where the pressure is. That's telling you that there's upward pressure in this price action that you may be able to take advantage of. The next thing to understand here is the significance of when multiple wicks are forming right next to each other. And so in this case, you can see the stock was actually moving up towards the volume weighted average price, and then we have this big up wick here. And then followed by that, we have another up wick, and then followed by that, we have an even larger up wick rejecting at the volume weighted average price. Again, this indicates where the pressure is, which is on the downside, and immediately afterwards, we get this downward move. We get this downward pressure down to this 427.80 level. That's how wicks can ultimately help determine which direction the stock may be headed. And again, nothing is 100%. This is certainly not going to work 100% of the time, but it is another tool that you can add to your arsenal to just try to identify where the pressure is flowing. The next concept I really wanted to talk about in this video is piggybacking off of strong moves in the market. Now, if you don't understand what I'm saying, a lot of the most profitable trades I get involved with are trades where I see a really obvious big move in the market, and then I take a subsequent dip or bounce to short into or go long into to profit from the big original move, if that makes sense. And so one of the ways I do this is I look for the volume weighted average price, and I try to look for big drastic moves either over or under the volume weighted average price. strong move above the volume weighted average price, I'm more likely to buy the subsequent dip and then look for a bounce off of that level. Again, I'm piggybacking off of this big rip over the volume weighted average price, but I just think that the move is a little bit too risky to get involved with prior to the dip, because a lot of the time these rejections here are going to be really strong and really fast, and so I don't really want to get stuck in that. But by waiting for the big move to happen and then just buying into the dip afterwards, I protect myself with less risk, and it's ultimately going to be a much more profitable way to approach these type of moves over and under the volume weighted average price. So here's another example on the short side. You can see this stock pushed up to test the volume weighted average price, and then we see multiple really large red candles indicating weakness and bearish action. And so instead of trying to attack this really big downward move, instead we're going to wait for this move to happen and then short into the small bounce up to test the previous low of the day. That way we don't have to risk getting involved when the candles are really swinging in a massive way. Instead, we can take the more reasonable, more accurate trade to get involved with and just short into the small pop after that. And we usually cover pretty fast here. I don't hold on to these very long. That's why I call it piggybacking off of much bigger moves here, because again, it's just a much more accurate way to trade. I think the win rate in this situation, if you take profit fast, is going to be much higher than if you got involved with it on this big red candle. And ultimately, that candle gives it confirmation, and everyone that sees this big move happening is then more likely to short into the area where I'm shorting into, if that makes sense. And so piggybacking off of really strong moves in the market is a really important concept that not a lot of other people teach in price action trading. You know, you look for big obvious moves that other people see, and then you capitalize on it once the risk lowers a little bit. Okay, so here's the last example of this very thing on the downside again. Again, you can see a big rejection at the volume weighted average price, and so instead of getting involved with this one when the risk is really high as the stock breaks under the volume weighted average price, I just want to piggyback off of this move and short into the small subsequent pop that we get right afterwards. That way I can use this previous resistance up here as well to help prop the trade down and profit on the downside, and I don't have to worry about a huge reversal on the upside, because in this case, if it breaks above the volume weighted average price, I can just exit the trade and come back to trade another day instead of risking more than that, if that makes sense. And you can even do this at the opening bell as well. Here's a big rip over the volume weighted average price. Instead of trying to jump in as the stock is breaking over the volume weighted average price, which honestly is where a lot of rookie traders get involved, and it just rejects on them really quickly. Instead, we're going to wait for the move to happen and then piggyback off of it by buying the small dip that happens afterwards as it pulls back to the volume weighted average price. Just like the last one, if it doesn't hold and starts dropping below the VWAP, we can cut the trade, but we can buy the dip and look to take profit at the previous highs of the day, thus protecting our trade with less risk. And it's just a much easier way to trade that, again, is going to be much more accurate as well. Anyways, team, that's it for this one. Remember, if you want to help support our completely free trading content, don't forget to hit the like and subscribe button. And if you want to trade these same exact scalping strategies in the futures market with no PDT rule, I'll drop a link for Top Step in the description. They fund traders in the futures market. Like I said, I use the same exact strategies in futures, and they're regulated and located in the US. They pay out millions of dollars every year to their funded traders and withdrawals, and they fund thousands of traders a year. Like I said, I'll include that link below. Be sure to check that out. Good luck in the market, guys. Remember, trading can be super risky, so make sure to take it slow, trade small, and we'll see you all next time. Good luck in the markets, team.